The new inflation report just came out yesterday and it was worse than expected. And this worse than expected inflation report caused the stock market to fall by more than 1,000 points. Now, the real reason why the stock market fell isn't just because we're seeing high inflation. It's what this high inflation means in our current economic cycle, but I'll explain that in just a minute. Let me start by briefly going over what this new CPI inflation report said. So economists were expecting inflation CPI to be 8.1% in the latest report, but it came out at 8.3%, so 0.2% higher. Month over month, they expected inflation to fall by 0.1%, when in reality, month over month, inflation grew by 0.1%. And then lastly, the Federal Reserve Bank loves looking at something called core inflation, which is when you take the CPI inflation report and then you take out some of the volatile numbers, things like energy, things like food, because according to the Fed, this gives you a more realistic approach as to what inflation is. And the expectation for this core inflation was to be 6.1% annual increase and a 0.3% month over month increase in core inflation. When in reality, it was a 6.3% annual increase in core inflation and a 0.6% month over month growth in core inflation. So a lot higher than what economists expected. And the reason why it was so much higher was because, well, food costs, shelter costs, rent costs, restaurant costs, furniture costs, new car prices, medical care prices all grew faster than expected. And this happened while gas prices were falling more than expected. Energy costs fell quickly, but the growth in everything else caused the CPI inflation report to be worse than expected. In fact, the food prices was a big topic because food prices grew at the fastest rate since 1979. We're now seeing food prices grow at some of the fastest rates in modern history. 1979 was when we were facing stagflation, and right now we're seeing food prices grow by almost 1%. We saw it grow by 0.8% month over month, while rent prices, shelter prices have grown by 0.7% month over month. So all of these things are happening while energy prices fell by 5% month over month, and we saw a 10.6% drop in gas prices month over month. Meaning, we have seen a big relief in gas and energy prices, which actually is happening not just because of what the Federal Reserve Bank is doing, but because of other global issues. I'll talk about that in just a second as well. But you have this slowdown in gas and energy prices while the price of everything else is still growing so fast. This is why the Federal Reserve Bank is now getting worried, and this is why now the market started to sell off because of what the Federal Reserve Bank might do because of this higher inflation report. Now, we did cover this whole story in Market Briefs. If you haven't joined Market Briefs yet, it is my free financial newsletter where every day my team is breaking down what's happening in things like inflation, the global economy, stock market, real estate, and cryptocurrency, and to break it down into a fun, witty, and easy to read email. That way you can stay up to date on what's going on with things like these inflation reports. That way you can be on top of this news. It's free and you can read it in less than 5 minutes every morning. So if you want to join Market Briefs, I'll put the link to how you can do it down in the description below. But this is where now you have to understand, what is the Federal Reserve Bank going to do? Because the Federal Reserve Bank has something called a dual mandate, which means that they look for two things. They're working for two things. They're working for price stability, aka they want to control inflation. And second, it's maximum employment, aka they want people to have jobs. But right now, they have achieved number two. People have jobs. The unemployment numbers are low. So they're not really worried about the unemployment thing, rather they're worried about inflation. And so the Federal Reserve Bank is seeing now that inflation is still high and people have jobs, so the Federal Reserve Bank needs to get aggressive to fight inflation. How are they going to get aggressive to fight inflation? Well, now that means they're going to continue to raise interest rates more aggressively. In the next couple of weeks or so, the Federal Reserve Bank is going to meet again to discuss what they want to do to raise interest rates, what they want to do to fight inflation. And you had people, traders, and investors hoping that the Federal Reserve Bank might not be that aggressive when it comes time for them to meet to raise interest rates. They were thinking maybe the Fed will start easing on their interest rate hikes. Maybe they'll only raise interest rates by 0.5%. But now that we have this higher than expected inflation report, this is more fuel for the Federal Reserve Bank to be even more aggressive to fight inflation. This more aggressive fight on inflation is bad for the economy, it's bad for the stock market because it makes borrowing money more expensive. Higher interest rates mean your mortgage is more expensive. Higher interest rates mean that your business has to pay more money to borrow money. Higher interest rates mean that if anybody borrows money, it is going to be more expensive. Everything becomes more expensive because of that. So it's a way to cool down the economy. It's a way to cool down businesses, aka businesses have smaller profits, aka businesses have to do more layoffs, aka stock prices fall, aka real estate prices fall. So traditionally, inflation is good for stocks, right? When inflation happens, people move their money into stocks. But now it's a different game because high inflation means a stronger fight against inflation. This is why now when you have these worse than expected inflation reports, you're seeing the market tank because investors are now worried, or traders are worried, of what the Federal Reserve Bank is going to do in response to the high inflation. And this brings me now to the topic of energy, because energy has been falling. Gas prices have been falling here in the United States, but in other places around the world like Europe, energy is a major crisis. Where Europe is seeing something like a 600% growth year over year in energy prices. They've seen something around a 300% growth in electricity costs. And so what is going on here? How come the United States is seeing this cheaper energy costs while places around the world are seeing more expensive energy costs? Well, there's a lot of different factors to that, but I want to focus on one key factor, and I want to focus in on oil, because oil is a commodity that is sold around the world and it has a global price. And the United States is very fortunate that oil is priced by dollars. And the dollar has been growing in value relative to other currencies around the world. Now, of course, the dollar has lost value since the beginning of the pandemic, but relative to other currencies like the euro, the dollar has grown in value. So what does that mean? A stronger dollar can buy more oil at the same price, because now your dollar can just stretch a little bit further, while some other currencies have seen weakening currencies, and so it takes more of their dollars to buy more oil. So we have been very fortunate here that yes, we've seen weakening of the dollar, but relative to other currencies, it hasn't weakened as much. And so this has kind of given the United States a little bit of a breathing room, especially when it comes to energy costs and gas costs, because now the dollar can stretch a little bit further, which allows us to buy oil cheaper, which allows gas stations to sell gas even cheaper. So if now things were to change, something happens globally with Russia, something happens to the supply of oil, something happens to the valuation of the dollar. Well, now all of these things would then trickle down to the price of oil, and if that happens, then that could significantly impact the inflation reports in the coming months, because the reason why inflation is only at 8.3% right now, which is not only, it is extremely high, we are near record highs, but the reason why it's at 8.3% and not 10% is because energy prices and gas prices have fallen so significantly. If gas prices were where they were just a few months ago, our CPI report would be significantly higher. So this is one thing that you want to pay attention to, that we're fortunate right now that gas prices are low. Part of this is also due to the fact that the United States has the strategic oil reserves, sorry, my words are not working, that are being released. And we've also implemented that federal gas tax holiday to make it a little bit easier for consumers to purchase gas. But the price of these commodities are really impacting people, and it's impacting CPI. But this is where you got to understand that if you look at the CPI here in the United States, you look at the inflation here in the United States that people have to pay for stuff, things like your groceries, things like your rent, things that you have to buy here, well, the cost of those things are growing very quickly, and it still does not look like it's slowing down, which means the Federal Reserve Bank is going to have to get more aggressive to fight inflation. So what does that mean numbers wise? Are they going to increase interest rates by 50 basis points, 75 basis points, 100 basis points? Well, most people think it's going to be 75 basis points. You have some people saying that it might be 100 basis points, meaning 1% or 0.75%. But this is where, we'll see in the coming weeks. But just understand the whole concept. The more aggressive the Federal Reserve Bank is going to be, the more it's going to hurt the economy, the more it's going to hurt the stock market, the more it's going to hurt the real estate market. And the reason why the Federal Reserve Bank has to do this to cool down inflation is because if you don't hurt the economy, you don't hurt asset prices to cool down inflation, then inflation is going to hurt the economy, and that's going to cause an even bigger issue. Now you run into things like stagflation, you run into a currency crisis, and this is significantly more painful than fighting inflation and inducing a recession in order to do that. So this is where You got to understand that, yeah, we might not technically be in a recession right now. A lot of these today, we might not technically be in a recession right now. You can expect the economy to slow down further. You can expect asset prices to continue to get hurt as long as the Federal Reserve Bank is going to continue to fight inflation. And this is where you want to be financially educated and aware of what's happening. That way you can make smarter decisions with your money. Now, the financial education is how do you invest your money, and the awareness is now being aware of what's happening. That way you can invest your money in the right places. Now, of course, when it comes to the awareness, check out Market Briefs. It's a free resource that I created to help you stay aware. The link is for you down in the description. And for the whole education side, there's tons of videos on my channel talking about how to start investing. So if you haven't checked those out yet, make sure you do. The job market is still very tight. Yeah, tech companies are doing layoffs. We are seeing job hires in other areas, but this is the beginning. And so where will it go next is what you want to pay attention to, because kind of like how inflation was just transitory in 2021, we're in a situation today where, hey, this economic slowdown might not be transitory like the Federal Reserve Bank and the government keep saying. It might be a real recession.